So economists use GDP to measure the total production in an economy. And for that purpose, for measuring total production, we try to make GDP as comprehensive as possible by not overlooking any production that takes place. Obviously, it does overlook some stuff, so goods that are not sold in a legal market, so in the black market, are not counted in GDP. Likewise, home production, so the value of goods and services provided by family members in the home, they're also not counted in GDP. So we're not getting everything of value that's being produced in an economy that's making people's lives better, but we're doing everything that's bought and sold, so it's pretty close. However, GDP is also sometimes used as a measure of well-being, so we can compare how well-off countries are with each other. And although it's generally true that the more goods and services that people have, the better off they tend to be, GDP only provides a rough measure of well-being. So there's two types of production that are omitted from the Bureau of Economic Analysis's measurement of GDP. The first being household production, which I mentioned. So things like childcare, cleaning the houses, cooking, chores you have the kids do, things like that, are typically not paid for by money. And even if they are paid for by money, they're not officially paid for in the economy, they're not registered and put on your tax returns, so they're not able to be counted. But again, these are serious contributions. If these are being performed by a non-household member, they would be paid for and counted in GDP. So this is value that GDP isn't able to measure. Also, the underground economy, or the black market. So buying and selling of goods and services that's concealed from the government, whether it's to avoid taxes, regulations, or to avoid prohibitions. This can be, some estimate it's up to about 10% of the U.S. economy. And in low-income households, this may represent a larger portion of income, and just that 10% figure. So we may be missing out on a lot of income for people. So we're being less accurate in our estimation of how people are actually doing. Despite these two shortcomings, GDP is a relatively good measure of total production in an economy. And it's hard to imagine a way to easily or feasibly for each 3-month period being able to get more accurate data. So if we compare GDP from year to year, if the size of household production and underground economy roughly stay the same, so if we're undercounting by the same amount or the same percentage every year, then we can get a lot of information from the changes in GDP over time. In this case, it'll be much more accurate because even though we're not counting these two sectors, we're missing out on the same proportion of transactions consistently. So we end up with something that's accurate over time or can be compared across time. So GDP growth, or we estimate that household production and the underground economy are about the same from year to year. We don't see large expansions and contractions over time. So GDP growth is a reasonable measure of growth in the total production. But over long periods of time, these shortcomings can become more serious. So in decades in the past, when women entered the workforce in larger and larger numbers in the 60s, 70s, and 80s, household production was replaced by paid childcare and by restaurant meals, an increase in people just going out to eat. So increases in GDP in that time may exaggerate the increase in total production because of the changes that were occurring. We've seen pretty stable labor force participation rate among both males and females over the past, say, 20, 30 years. So it's likely that these changes are no longer occurring and we don't have these inaccuracies now that we may have had decades in the past. Now, just because this isn't a problem for the U.S. economy for measuring GDP doesn't mean it's not a problem for trying to measure the GDP in other countries. So in developing countries, the underground economy, which we call the informal sector, it's often quite large, sometimes even above 50% of total output in a country. So because of that, it can be very difficult to compare GDP across countries at different levels of development. So when economists that study economic development, when they talk about it, they say this often reflects poor government policies, that there's problems with governance, that maybe they don't protect property rights, or maybe the government itself is involved in extraction or extortion from people involved in the market. So instead of being in the formal sector, in the economy that has the legal protection of government and is overseen by government, they engage in transactions in the informal sector. So what's like the black market here. Now, GDP per capita That's the measure of GDP divided by the total population. So we have the GDP for each individual, or the total income average across all the individuals. Now, this is often used to represent the differences in the standards of living from one country to another, or in one country over time. Even if this accurately measures total production, though, it may not reflect other things. So we may be missing some stuff. For instance, the value of leisure, pollution and the other negative effects of production, crime and social problems, and the distribution of income. So for example, lower crime rate would lower spending on police, on prisons, on private security. So in essence, this is going to decrease GDP, or at least the government spending portion of GDP, but it's definitely going to result in improvements in well-being, whether it's economic well-being or just in people's happiness and in their stress levels. So sometimes improvements in these can result in lower GDP per capita. So technically, our statistics look bad, but in fact, people are becoming happier because we don't have to spend money getting rid of bad things because the bad things are going away. Now we're going to move on to real GDP versus nominal GDP, and we'll discuss the difference between the two. So suppose GDP increases from one year to the next. Is this increase in GDP due to production increasing? So are we producing more goods and services or more valuable goods and services? Or is it due to just prices increasing over time? Just looking at the numbers, we don't know at first. So in order to separate these effects, the Bureau of Economic Analysis calculates both nominal GDP, so this is the total value of all goods and services evaluated at the current year prices, and they also calculate real GDP. That's the value of final goods and services that are evaluated at base year prices, so that adjusts for inflation or for the increase in the price level over time. So we can use any year's prices to compare real GDP. The current standard we use is 2009. The previous one before that was the year 2000. We typically just pick a year and stick with that for GDP for a while. But there is one slight problem we need to remember, that the relative prices between goods also change from year to year. So that makes it a little more difficult to calculate GDP statistics. So since 1996, the BEA has overcome this problem. They use what's called chain-weighted prices. So they use previous year prices to adjust current year production. That's not something we need to go into the depth into in this class. Just to know that there are some concerns with relative prices, and the BEA has taken steps to try to adjust for that and to make our measures more accurate. All right, so let's use an example to calculate real GDP and to see what this means. So let's suppose there's a very simple economy that produces only the three following final goods and services. So we're looking at eye examinations, pizza, and shoes. Let's use the information on this table to compute real GDP for the year 2019, using 2009 as the base year. So if we calculate the total value of output in 2009, so if we multiply the quantity times the price in 2009, we end up with $5,540. So that's our total output, or our gross domestic product for 2009. So if we want to calculate real GDP in 2017, we're going to multiply the 2017 quantity by the 2009 prices. So we multiply those together, the 2009 price and the 2017 quantity. We end up with real GDP in 2017 of $6,680. Now the nominal GDP, if we multiply the quantity in 2017 by the price in 2017, we end up getting a nominal GDP of $7,800. So the nominal GDP accounts for inflation, the general rise in prices that tends to happen over time, whereas the real GDP adjusts for that inflation. So we're just getting the increase in total production in the economy, rather than also getting that inflation involved. So if we wanted to compare from year to year, using real GDP is a more accurate measure of how total output is increasing or decreasing in an economy. So the current base year for calculating prices is 2009. We'll use that as our base year for determining real and nominal GDP. So real and nominal GDP are going to be equal in 2009, because the value of goods and services are going to be the same. It's going to be the same calculation for 2009. So there's a figure on the right that shows real GDP and nominal GDP from 1990 to 2014. So the base year 2009 is where the real GDP and the nominal GDP curves cross because they're exactly the same. Nominal GDP has a greater slope, so greater increase over time. That's because we're also accounting for inflation in there. Whereas for real GDP has a more shallow slope because we've removed this inflation from there. So there's going to be less growth because we're not capturing the general increase in the price level. Economists and policymakers are also interested in the overall price level. So this is a measure of the average prices of goods and services in the economy. And they're interested because stable prices are desirable. I think we can all intuitively understand that as consumers, we want stable prices over time. It makes it easier to plan for the future, and we don't have to deal with increasing costs over time. So in order to know whether we're achieving price stability, whether we're actually not having these prices dramatically increase and decrease, we need to measure the price level. There's several different ways we can do this. The one we'll talk about in this chapter, because it's related to GDP, is using the GDP deflator. So this is a measure of the price level that's calculated by dividing the nominal GDP by the real GDP, and then multiplying by 100 so we can get it into percentage. Since nominal and real GDP will be the same for the base year, the GDP deflator will always be 100 in the base year. So let's give an example of how to calculate the GDP deflator. So look at 2 years, 2013 and 2014. In 2013, the nominal GDP was 16,768 billion, and the real GDP was a little bit lower. It was 15,710 billion. In 2014, the nominal GDP was 17,419 billion, and the real GDP was 16,086 billion. Remember, our formula for the GDP deflator is the nominal GDP divided by the real GDP times 100. So we'll have to apply this to both 2013 and 2014 so we can get the change in the price level. In 2013, the GDP deflator equals 106.7 when we divide the nominal GDP by the real GDP times 100. Using the formula in 2014 as well, we end up with the GDP deflator of 108.3. So the GDP inflator increased from 106.7 to 108.3 from 2013 to 2014. So if we want to calculate a change in the price level, we just take the change of that. So 108.3 minus 106.7 divided by 106.7. Then multiply that by 100, and we get our percentage change, so 1.5%. So using the GDP deflator, we can say that the price level rose by 1.5% over this period. Now we're going to end by very briefly looking at some alternate measures of total production and total income. So each quarter, the BEA publishes not just GDP, but the National Income and Production Accounts Table, which has several other measures. So this includes gross national product. So this is production performed by citizens of a nation. This includes overseas production. U.S. firms often have facilities in foreign countries, and foreign firms have facilities in the United States. So for example, Ford has assembly plants in the UK, and Toyota has some in the United States. So what GNP does, different than GDP, is it includes foreign production by U.S. firms, but it excludes U.S. production by foreign firms. So for the United States, GNP is almost the same as GDP. They're roughly the same. They're about 1.1% difference. Now for many years, we used GNP as the main measure of total production. However, in many countries besides the United States, a significant portion of domestic production takes place in foreign-owned facilities. So for those countries, there's a large difference. GDP ends up being a lot higher than GNP, and it's a more accurate measure of the level of production within that country's borders. So we use GDP now because it's the most easily comparable between countries. Next is national income. So for that, we use the GDP minus the consumption of fixed capital. So that's the depreciation. So these capital goods, whether it's like an automobile that you own or whether it's machinery used for the production process by a firm, over time their value decreases as you use them more and more because of the wear and tear on them. They have lower and lower resale value. So national income takes into account this depreciation over time. The next is personal income. So this is income received by households. This includes transfer payments, but it excludes firms' retained earnings. So retained earnings are firms' profits that instead of giving to either shareholders or giving to the people that work and own in the company, the profits that they earn in a given year, they take that money and they reinvest it in the company. Finally, the last type is disposable personal income. So this is a measure of personal income, but it's minus the personal tax payments. So this measures the amount that households are able to spend or to save. These are each alternate measures that give you some idea of the level of spending and production in an economy. So here we have a table and a graph that show the various measures of national income that we talked about on the previous slide for the year of 2014. So national income, it has to be by definition smaller than GDP because it's GDP minus the depreciation. But you see that GDP is $17 billion in 2014. National income is about $15 billion, so it's still roughly the same. In the same vein, disposable personal income has to be less than personal income because it's, by definition, personal income minus taxes.